All right. Well, hello, everybody. My name is Lori Amos. I am a realtor in Reno and Sparks, and we have, Jorge and I, decided to do this presentation for pretty much anybody who is curious about what impact the coronavirus pandemic has had on our local real estate market. So Jorge and I work a lot. We have together multiple clients over the last 8 years since I've been in real estate, and put together this presentation really for the Washoe County Bar Association because we do so much work within the divorce realm of real estate and mortgage lending. But the information was so important that we figured we would kind of alter the presentation some to have it be applicable to the general public. So that is pretty much what we intend to do right now.
Definitely. Thanks, Lori. Jorge Montoya here, local mortgage banker and also certified divorce lending professional. And as Lori mentioned, as this slide shows, the game has changed completely when it comes to real estate and lending. And I mean everything, the way we operate, the way we transact, the way that we view risk when it comes to lending has completely changed. And we're excited to share what those changes are and what the new atmosphere looks like. This way you're better prepared.
Absolutely. Alrighty, so I'm going to just go ahead and jump into the topics that we're going to be covering today. So in regards to real estate, we are going to be going over the current state of the real estate market, the selling process during shelter in place, so what showing properties and selling properties is looking like right now, title, escrow, and recordings, the determining of property values, evictions and foreclosures, and then of course looking ahead in the coming months. On the mortgage side, Jorge is going to go over the status of the current mortgage market, interest rates, and impacts the coronavirus has had on that, delays and realistic timelines, new appraisal guidelines, impact on mortgage approvals, so new loan approvals and existing loan approvals, we'll get into that in a minute, 90-day mortgage grace period, and then of course looking forward as well. So what we want to look at first in regards to real estate is basically the market climate or the market condition previous to coronavirus. So what was the market looking like just before all of this hit? And so the good news is that the real estate market was very healthy. We had a very strong real estate market and we had a very strong economy. The GDP was at 2.1%. Our unemployment rate was the lowest it's been in 50 years. Interest rates were at historic lows. And even though the housing prices continued to go up in Reno and Sparks over the last 9 months, really, it's been longer than that, but that's been a pretty consistent uptick in price. Despite the fact that the prices were going higher, the average mortgage payment was actually getting lower. That is a direct reflection of the interest rates dropping. So as an example, just this last November, so November 2019, FHA rates were at 4.62. As of last week, it says today, but of course we restructured this presentation, but as of last week, interest rates were at 3.62. So on a purchase price in Reno Sparks at $350,000, we'll call it right underneath the median home price, at 4.625, that payment would have been $1,736 a month. And at 3.625, that payment would be $1,540. So you can see right there, just from November to now, what a significant difference that interest rate can have on a monthly payment. Another thing that we actually had in our favor, or in favor of the values of property maintaining and growing, was our inventory shortage. So we've had massive growth in Reno and Sparks. The building has not kept up, and because of supply and demand, that has been the #1 determining factor in the prices in Reno and Sparks continuing to go up. So with that said, there were concerns kind of across the board. I've gotten a lot of questions about whether or not the increase in prices consistently month over month was leading us into another housing bubble or market crash or market crisis. And so what we do to look at that is this next slide here. So what this slide shows is basically what is different from the last market crash that we had and what our current situation was going into our our current situation. So the most important thing to understand is the difference here that you can see. So the blue line, if you notice, this blue line right here indicates house buying power. So the power of the general public to buy a house, okay? The green line here represents the median sales price. So this is on a national level, okay? So what you can see here is when it flips, right? So right here, right around 2005, when the median house price outpaced the average household buying power, that is what is considered a housing bubble. So you could see that's what led basically to these gray areas here, which of course is the last recession that we had that really hit around 2008, 2009. So if you look forward on the chart to where we are today, look at the difference. Look at how much higher the values are in comparison to buying power. So that's actually a really, really good sign. Very reassuring. So now if you flip over to the next slide here, this one talks about household income, so debt to income ratios, right? You hear a lot about that when you're talking with a lender about debt to income ratios. So this one actually shows some really good news also. So what this one shows is that since the last recession, it seems that a lot of people really learned their lesson in affordability. So the gray areas, again, represent recessions. And if you notice, you can see that the debt to income ratios peaked during periods of recession. And then look at where we are today. We're very, very low. So basically overall, the financial condition of the American household is very good. It was very good going into our current situation. So this basically again is the national numbers, but we're going to take a look at Reno Sparks a little bit more in depth here. So this first slide here is an overview of unsold properties. Okay, so basically anything that was on the market at the time that this situation occurred that either expired, meaning the listing it timed out and did not get renewed, or the seller canceled their listing, or the property was temporarily taken off the market. So this is week over week for the month of March from 2019 to 2020. Okay, so really not too much of a difference until the very last week of the month. So we'll get into why that is here in just a second. So this next slide shows prices. So you can see consistently that 2020 was quite a bit higher than 2019, which again is just a reflection of the fact that we have constantly and continuously been going up in value. But what is interesting to see is that, you know, while people were kind of in this panic mode thinking that, you know, the housing market was just going to instantly crash, this is not an indication of that, at least at this point, okay? This chart to me was really not very surprising. The main reason being, in the real estate world, everything kind of works in a 20 to 30 to 45 day time frame, okay? So these numbers here reflect prices that housing prices that sold, so closed, like actually closed escrow during the month of March, which means that the majority of these were already in escrow before this situation came into play, okay? So really what we saw more impact on was not necessarily price in the month of March. The main thing was that there were multiple properties that did fall out of escrow for reasons such as loss of job, loss of wages, changes in the lending guidelines, things of that nature. And so Jorge will get into that a little bit more in detail in his section. What's not noted in here, because we did update this presentation from the first time, is the impact that we did start to see going into April as far as the median home price in Reno and Sparks. So just to kind of give you an example, if you want to go ahead and jot this down, on March 28th, the median home price was noted at $400,000. As of April 4th, it had dropped down to $382,500. And then the most recent that I was able to pull from the Northern Nevada MLS was on April 11th, and it had dropped down again to $365,000. So definitely some impact there on prices, but we did not start to see that until just the last couple of weeks. So with that in mind, one of the questions that we've been getting a lot, or I have anyway, is how are things going right now with shelter in place in effect? Okay, so with shelter in place in effect, there has absolutely been some changes that we've needed to implement. So what this talks about right here is the life of a listing. So basically the time that the property comes on the market to the time that it closes escrow. So there's 3 key points where we actually have to physically go out to see the house. I'm going to kind of skip around on the slides here for 1 second. We'll pop back to this in a minute, but it's important to note these dates, okay? So March 17th was the official date that Governor Sisolak clarified the guidelines and stated that the closing of the non-essential businesses was mandatory, whereas the day before the mayor had stated that it was recommended, and then of course the next day he stated that they were actually mandatory. So what was unclear at that point was whether or not real estate and lending was going to be considered as essential or non-essential. On March 20th, it was made certain that real estate was officially listed as an essential business. So we have technically been in service this entire time. We have not had any disruption as far as ability to work. It's just how we are conducting work that has changed. One of the more recent changes was that we were doing virtual buyer tours. We were doing virtual open houses. On April 8th, the governor actually mandated that there are to be no open houses, period, and also issued a directive stating that properties that are tenant occupied cannot be shown at this time. So if an owner has their house on the market and they choose to allow for showings to occur, that is certainly within their right, but they are not allowed to overstep a tenant's request to not have people come through their home during this pandemic. So any tenant occupied properties right now are not able to be shown. So let's back up here real quick to the life of the listing. So times that it's imperative that we see a property. Number 1 is obviously the physical inspection of the property. So when a seller reaches out to a realtor, such as myself, asking about selling their home, we do have to actually go physically see the property. We need to see the condition that it's in, any upgrades, any improvements that it might be needing, repairs, things of that nature. So that is one time that we absolutely have to see the home. The other time that it's going to need to be seen is when it's actively on the market. So when there's actually buyers coming through to look at the property. And then of course the home inspection. So when the home is in escrow and now we've got a loan process to abide by, we have to get a home inspection. He has to physically go out and see the property. Now you could see right next to a home inspection, the appraisal is actually not one of the highlighted periods of time that the property needs to be physically inspected. Normally that would be the case, but with things being as they are, that has been one of the things that has been affected. And again, Jorge will go into that in a little bit more detail during his section of the presentation. So we already went over that slide there. We're going to go ahead and move on to the next one. So what does looking at a home or selling a home look like right now with the stay-in-place order, shelter-in-place order in effect? So although we can still show properties, we have had to implement some guidelines to make sure that ourselves and the public is safe and protected. So maintaining social distancing guidelines is certainly in effect when showing properties. The seller is advised not to be in the home during the time of the showing. Most of the time they aren't, but there are certain situations where they'll just stay home or maybe step out into the garage or maybe in the backyard. At this point, we are asking them to not be present. So they are to physically leave the home during the time that we're showing the property. Virtual showings whenever possible. The way that I've kind of worked around this and implemented it to kind of work on both ends is if a buyer is interested in a property, most of the time, unless it's vacant, most of the time I will show them the property via video. So like something like this, Zoom or FaceTime or something of that nature. At that point, if it's determined that they are genuinely interested in that property, then we'll schedule a physical face-to-face for them to actually come out and see it in person. And then communications and activities to be electronic anytime possible. That's really not too much of a change within the real estate world for me personally and most realtors. A lot of what we do is with technology, so that hasn't changed too much. The other thing that I would say that isn't noted on here, this is something more specific to me personally, is I do what I've called a hands-off approach to showings. So if I'm showing a property to clients, I'm going in first with gloves and a mask. I'm opening doors, opening windows to get some fresh air kind of flowing and circulating through the house. I'm turning on light switches. I'm opening doors and cabinets. My clients are not to touch anything, literally hands in pockets, and they are not to touch anything at all during the process of the showing. Another thing that we have implemented in regards to showing properties is we are not doing any brochures or flyers. I personally don't really do this unless I'm doing an open house. It's kind of an old school practice that I just don't really partake in very much. So that hasn't been too much of an effect for me, but that is real estate across the board. And this one, again, is kind of subject to each realtor. So pre-approval, ready, willing buyers able to visit homes. Most real estate agents will not take a buyer out to see a property unless it has been verified that they have their funds in order. So they've been met with a lender and they've got their funding secured. This is actually a requirement now per the state. So if you do not have a pre-approval with a lender, you will not be allowed to view properties, period. Seller to leave lights and doors on or open and on. Again, if it's a vacant property, that's something that we're doing before we're allowing our clients to come into the home. No open houses as of the moment, but we are still being permitted to access the property for inspections and appraisal purposes. So this next slide is the coronavirus addendum. So this is a new form that has been implemented by the Northern Nevada Multiple Listing Service. So this form basically gives you some loopholes or gives you some flexibility on the seller side or the buyer side if something should occur during the process of the transaction that prevents them from purchasing or selling the home. So for example, when you're purchasing a home, you have several opportunities where you can legally get out of the contract. If there's issues with funding, if there's issues with the condition of the home that are determined at the point of inspection, if there's something that comes up with the appraisal, things of that nature. Those are legitimate reasons to get out of the contract without any repercussions. Because things are changing so rapidly right now with the coronavirus, illness, loss of job, loss of income, changes in guidelines to approvals, things of that nature. This form was basically created to protect both the seller and the buyer. If something that is out of their control, that is a direct reflection of the coronavirus, prevents them from moving forward and completing the purchase. So that is a new form that we have just started using. Title, escrow, and recording. So this slide actually has not been updated, but walk-in recordings are no longer taking place. So if you're not familiar with that, walk-in recordings basically means the time that the assessor, so the Washoe County Assessor's Office, records the fact that ownership has changed hands. So the buyer has taken ownership from the seller. They are, however, still happening electronically. So we are still able to record and process and change over ownership electronically. Title and escrow companies are still open. This is pretty much subject to each office. So in other words, different offices have different protocols in place since the coronavirus has been in effect. So some of them are still doing walk-ins, live, sit down, face-to-face, gloves and masks. I do know in most situations they are asking that it is, and this goes for showings as well, that it's just the clients. In other words, a lot of times we have family members that will tag along, excited kids that are ready to see their new home. The only people that are being permitted to attend these face-to-face are the people who are needed there to sign the necessary documents. We've even got one local title company where the gal has a cart, like a rolling cart. And when you get there to sign with her, she will actually roll the cart out to your car, roll the window down, and she stands there with glove and mask, and she'll do all of your signing through the window. So a lot of people have gotten really creative with how to still service their clients and keeping everybody safe and protected. So valuing properties, let's go ahead and dive into that. So determining the property value. There are so many things that come into play in determining the property value. It's really important to make sure that we are checking this on a regular basis. If you're looking to purchase or if you're looking to sell, this is something you want to keep a very close eye on. As you can see, just from the end of March into the second week of April, look at what a significant difference that made. 400,000 to 362 roughly, 364. So something that you absolutely want to keep an eye on. In a normal real estate world, Values change on a monthly basis, every 30 days. Every time a new property closes in your neighborhood, that is having a direct impact on that neighborhood's value. So that's something that you always want to keep into consideration, because the most recent comps are what is given the highest amount of value in an appraisal process. So it's something to keep in mind. And then appraisals down here, again, we'll go into this in more detail during Jorge's section, but timing is critical. And the way that the appraisal is being processed on your home, even if it's on a refi, is really, really important. So you want to know what that entails as we get into the mortgage section of it. So moving on, payment forgiveness. So we're going to kind of bounce away from purchasing for a second, and we're going to talk about renters, landlords and renters, okay? So Governor Sisolak's recent orders basically stipulated the ban of any new notice to pay or vacate, the ban of any lockouts on any previously ordered evictions, so they cannot be enforced right now. Even if the eviction technically was filed right beforehand, they are not enforcing any lockouts at this time. It bans any new filings on evictions, and then it's also recommending that landlords are waiving the fees, any late fees. Basically what he is recommending and urging is that you work something out. The landlord and the tenant have to communicate and work something out. Of course, this is going to be more on a private owner situation than it's going to be like, say, a property management or like an apartment complex, like a corporation. So just kind of keep that in mind. But at the end of the day, basically, it's going to be similar to what Jorge will go over in regards to the lending side, is that everybody's going to be a little bit different. The main thing that we want is to make sure that you are being proactive. If for any reason you cannot pay your rent, you need to be reaching out to your landlord before you don't make that payment. Find out what your options are. Make sure that you understand clearly what your options are, and that any type of payment arrangement that you make with them to work out to make that amount up, that it's realistic for you. In other words, you're not getting yourself into a situation to bypass time, but you're not ever going to realistically be able to satisfy the agreement that you've now made with your landlord. The other thing to take into consideration, again, is if you are stating to your landlord that you can't pay your rent because of something in regards to COVID-19, he's most likely, they are going to want some sort of proof. They're going to want to see that there's an illness or that there's a loss of income or loss of job or something of that nature. So at the end of the day, what we always say is if you can pay it, you should. So moving on to mortgage forbearance and foreclosures. What we know at this point is that several of the bigger banks and multiple other lending institutions have agreed with the governor's urging to work out some sort of payment solution with their borrowers. Options, again, are going to vary. Each bank is going to have their own set of stipulations and options. In some situations, we know that they're going to be giving you kind of a 90-day grace period. In other words, you'll have 90 days to not make your payment, skip your payment, but then they're going to want full payment right then at that 90 days. Or in some situations, they might be tacking it on to the end of the loan. Forgiveness is, lending forgiveness, mortgage forgiveness, where he'll go into that during his section more, but you really want to make sure that you are understanding the terms that you are agreeing to. And in both situations, whether you are a tenant or you are a homeowner, you always want to get something in writing. So make sure that you understand it and that also you are getting it in writing so that it can be referred back to later on. Something that we kind of want to caution on, and we're going to get into this in the next slide as well, so we'll kind of drip over into the next section, is the foreclosure timeline. So just kind of generally speaking, this is the normal timeline of a foreclosure process. 90 days late, so 3 months worth of no payments on your mortgage, is when the lending company can issue what is called a notice of default. Okay. Another 90 days will typically pass before you'll get what's called the notice of trustee sale. This is basically letting you know that they are getting ready to enforce their right to sell your property. Okay. Typically about another 21 days will take place from that point until the time when they can actually sell your property. So the reason that we're bringing that to light is because you can see 90 days, 21 days, that is not that much time. What happened a lot in the past or with the last recession is that people were kind of just sitting and waiting and seeing what was going to happen, hoping for the best. And what we found very often is that the moment that the bank can foreclose, they will. So waiting to see what the bank is going to do, hoping that they're going to give you a 90-day grace period and that you'll hopefully be able to catch back up, is absolutely the worst thing that you can do. You really want to make sure that the options that you're agreeing to are realistic for you to fully execute. Because if the bank can foreclose on you, most likely they will. And that is something that we are a little concerned about in our industry, real estate, mortgage in general, is that people are going to be getting themselves into situations that they don't realize the impact they're going to have down the road when things start to go back to normal. So something really important to be aware of. To summarize, a lot of the questions that I've been getting right now are, is it a good time to sell? Is it a good time to buy? My comment to that is it really depends on each person's situation. On the seller side, it's not going to sell if you don't put it on the market. If you need to sell your property, if you have to sell your property, if you want to sell your property, you have to put it on the market. There's very, very real precautions that have been put into place to make sure that we're doing it as safely as possible. But if you don't put your house on the market, it's not going to sell. That's the bottom line. The upper hand that you do have right now is that a lot of people have put their properties on hold. They're on pause right now. Whether they were in an active listing agreement or not, they put them on hold because of this shelter in place. So on the positive end, as a seller, you don't have a lot of direct competition. And the same goes on the buyer side, is that a lot of people have kind of halted their home buying for the time being, and which means that there's just not a lot of competition, meaning direct competition. You know, it could be you and 3 other people that are all interested in 123 Main Street. Whereas right now, with the way that things have kind of slowed in the real estate market in general, you might be the only person offering that person to purchase their house. So sometimes it gives you a little bit more flexibility as far as negotiating is concerned. At the end of the day, it really depends. Each person's situation is going to be different. I am taking that on a case-to-case basis, finding out what the motivations are, what the needs are, what the wants are, and then making sure that the timing is right. There's certainly advantages on both ends right now. Absolutely. Property values. So how is it going to be affecting the property values? We've already seen that it's starting to affect it in the negative, which is not surprising at all. How long do we expect it to last? That's really, at this point, it's very hard to say because we are still in the middle of it. We don't know how much longer before they're going to reopen some of the non-essential businesses and some people will be able to go back to work. So at this point, it's really hard to say. It's going to very, very much be directed by how and when we start to reopen and get things kind of back into a normal sense. If a property's on the market, how long is it going to take to sell? So if somebody's looking to put their property on, we are saying basically expect another 1 to 3 months on top of whatever the normal days on market is. So if it's typically 2 months, you're looking at about 5. And that's just kind of giving you a general idea. Of course, you know, some properties will sell a lot quicker and some of them will take a little longer. And then, of course, the number one thing, can I stop paying my rent? Can I stop paying my mortgage? We already went over that. So just to reiterate, talk to your landlord before, talk to your mortgage lender before, find out what your options are, make sure that you fully understand them, make sure that you're getting into an agreement that you can fully execute, and make sure that you always get it in writing. So those are my little tips there. Looking forward, so what can we expect in the future, in the coming months and weeks? What some of the positive things that we have on our side in regards to real estate is that we did go into this in a very strong economy. We came into this in a very strong position. So whenever you go into something in a stronger position, your recovery time is typically a lot quicker. We do still have low interest rates, which is a plus. We are going into our high season. So typically speaking, summertime is usually Reno's peak season. And so we do still expect to see that to happen. What we do expect also, though, is that there's going to be a little bit of a delay, and that's going to be a little pushing out of that. So where we would normally see our peak, say in July, August, we might be seeing that in more the fall. But we do still expect to have a pretty decent year. Something that's also going to help the sellers as far as value and Reno Sparks in general is maintaining their overall value is the low inventory. We still have an inventory shortage. That's not going to be something that's going to be corrected. If anything, it's gotten a little bit tighter because of some of the people that have pulled the properties off the market because of the coronavirus. So that is something that was going to help correct the market once things start to normalize again. On the positive end as well, this time around, there is the stimulus package that's been offered to anybody who's been affected, whose income has been affected or their work has been affected. So obviously that's not going to help everybody's financial situation across the board, but a little something is certainly better than nothing. Now on the con side, as far as the economy looking forward or the local market looking forward, the biggest thing that I say right now we have challenges is the consumer confidence. So anytime we have some sort of national disaster, we'll go ahead and call it, there's just fear. There's consumer fear of the uncertainty. We don't really know what's going to happen yet, how much longer this is going to last. So it just generates a lot of fear and anxiety, and people are hesitant to make a big financial decision during those times. Unemployment right now obviously is on the high side. Again, we expect to see that correct once the non-essential businesses are able to reestablish some sort of regular business. Mortgage delinquency, that is a big one that we have some concerns about. And again, this is going to be those situations where people are getting themselves into these 90-day agreements without any way to actually pay that money at the end of the time frame that they're given. And then we're going to see an increase in foreclosures. So, you know, that's something to keep an eye on. Government limitations over the private sector. Basically what that means is just, we don't really know what Governor Sisolak is going to say in the coming weeks. It could be, you know, loosening up in 3 weeks. It could be another full month. We really don't know. Until we know those things, it's going to be kind of, you know, touch and go. Jorge and I plan to put out some updates, I would say at least on a bi-weekly basis, if not on a weekly basis. The market in a minute is absolutely going to be coming back. I'm probably going to find a way to implement Jorge into that, because I think it'll be important to also look at rates. But that's something you just want to keep an eye on. If you know somebody close to that area, just kind of keep an eye and see where things are going in the coming weeks and in the coming months. So that is my section on real estate, and I'm going to go ahead and turn it over to Jorge on the mortgage and finance section.
Awesome. Well, thanks so much, Lori. A lot of information, a lot to consider when it comes to real estate these days. So now let's talk about mortgage and finance. So let's jump onto the first slide. And here's what we're going to talk about during this section. Number one, we're going to talk about the status of the mortgage market, interest rate and its impact, delays in realistic timelines, new appraisal guidelines, impact on mortgage approvals, which is currently mine and everybody's biggest pain point, 90-day grace, mortgage grace period, and then we'll give a little forecast of what to expect in looking ahead. But first, let's begin with the status of the mortgage market. Now, we're going to break this out into two different sections. We're going to talk first about product availability, and then we'll break it down to today's market versus 2008. But let's begin with product availability. And right now, we are in a very fluid market when it comes to product availability. And we're actually seeing quite a bit of shrinking and retracting when it comes to products, especially when it comes to high-risk loans with limited or little to no access. Same thing with jumbo loans, same thing with down payment assistance. Now, all of this, because of our current environment, lenders these days are reevaluating what their tolerance for risk is. So now you've got an implementation of stricter guidelines, or as we know in the industry, the return of lender overlays. So let me explain what a lender overlay is. So FHA, Fannie Mae, Freddie, VA, USDA, all these agencies come up with these guidelines, and then they give them to the bank and say, hey, Lori, here is what you should do when it comes to an FHA client, and we want you to have, let's say, a 580 credit score. And then now that lending institution may either just adhere to the 580 credit score and lend their products that way, or they may say, well, that's great, FHA, but we're not too comfortable with that. We actually want you to have a 640 credit score, which is what we know as a lender overlay. So don't be surprised that nowadays when it comes to financing, you see more requirements, higher credit scores, maybe some proof of savings, 1 to 2 months worth of reserve savings. So you're seeing lenders' appetite for risk definitely shrink and look different. So more stricter regulations is something that is the new normal and probably expected to continue. Now let's talk about today's market versus 2008. And let's take a trip back to 2008, which was the time where all reason and logic literally went out the window, and we were introduced to a highly sophisticated mortgage underwriting mechanism, which I'm about to demonstrate. 2 fingers. Yep, got a pull approved. Here's $500,000. Go find a home, Lori. It was ludicrous. No verification of income, no verification of assets, interest only, negative amortization loans, just high risk loans that were happening in 2008. And credit was flowing and consumers were eating it up. If you could buy a $1 million home with a $2,000 payment, why wouldn't you? Well, that was the thought process behind it, which I will say was a very painful time for me, because during that time, we weren't doing that risky lending. So you come and talk to me, I show you a real payment, you go talk to the next door neighbor, they show you half of my payment, and all of a sudden they seem more attractive than the options we presented to you. So very painful time. As we know, that was not a good time, and it was really a blessing in disguise that we did not participate in that risky lending. And there was a massive, super expensive financial lesson learned because of risky financing in 2008. Now, all of this led to the Dodd-Frank reform law being presented, which then established what a QM, qualified mortgage, is versus a non-QM, non-qualified mortgage. So a QM loan, qualified mortgage, is your traditional loan, verifying your income via tax returns, pay stubs, W-2s, your traditional way of verification methods. But then you've got non-qualified mortgage, which is your riskier alternate documentation loans. For example, let's say a bank statement loan. If I can't provide you with pay stubs, W-2s, because maybe I'm self-employed, then a lender out there might be willing to give me financing based on 2 years worth of bank statements and 2 years worth of deposits to come up with some sort of income, which was known as a QM loan, which nowadays very limited to no access because of the current environment that we're in. Now, the laws have changed. Lending landscape has changed in a big way. Fewer high-risk loans, like I just mentioned. Over the last decade, it is very rare to see those non-QM loans. You're mainly seeing the traditional verification loans. And then big difference today versus 2008 is, Lori touched on this, which is the fact our economy is in a much different place than it was back then. We have a good job market. We're just currently being told at the moment not to go work. But the jobs are there. We're just not allowed to go do it for the moment. And then the big difference also today is that today's owners are actual owners. Back in the day, when everything popped, sellers were not your traditional person. It was banks and short sales and foreclosures and just distressed sales. And nowadays, you actually have equity owners and equity sellers. So people today in today's market are equity rich. They have equity in their properties. So let's jump over to the next slide. So delays in realistic timelines. Right now, servicer provider delays are inevitable, unfortunately. Actually, I think we skipped one more. Interest rates. There we go. So interest rate impact. It's amazing to me how volatile the market is. And I got to clarify for you, the current mortgage interest rate is not 0%. Contrary to popular belief, many of you have heard that the Federal Reserve had cut the Fed funds rate to 0%. So many consumers now believe that that is the traditional mortgage rate, which it is not. The Fed funds rate is the interest rate at which banks borrow from, not to be confused with the mortgage rate that you and I as a consumer borrow from. Mortgage rates are more attached to the Treasury bill, mortgage-backed securities, not the Fed funds rate. So I just want to make that quick clarification. And that's why they're so different. Now, what I will tell you today is that we're seeing massive swings. You may be able to lock in a 3.6 rate or 3.3 rate, which I will throw in there. The last time I saw rates below 4% and sometimes even below 3% was back in 2011 during that great recession that we lived. So in the 15 years of lending that I've been doing this is only the second time in my career that I've seen rates this low. But going back to the volatility, you might be in the low threes today, and then some new economic information gets released tomorrow, and then you go back up to maybe the high threes or maybe the low fours. Right now, it is very volatile when it comes to the interest rate, so don't be surprised to see major swings. big dilemma that everybody's facing right now is lender pipelines. So because today's environment can create a low interest rate opportunity, many homeowners are taking advantage of that. So if you're currently at a 5% rate and you can drop down to maybe 3.25%, why wouldn't you? You would want to refinance, drop your payment, maybe drop some mortgage insurance, cut your loan term. And when you have millions and millions of people doing this, then now lender pipelines become massively flooded. So picture a hose and a watermelon trying to move through that hose. It ain't going to be fast. It's going to be a slow process. So turn times right now, you can really expect 60, 90, 120 days when it comes to closing a purchase or a refinance. Now, that is not the normal. Normally, you'd be able to close a purchase or refinance in 30 to 45 days. But right now, you can expect longer turn times because of these massive pipelines that we're so very thankful for, but they do come with some consequences. Now, all aspects of lending and production have been delayed, which we'll talk about here in the next slide here. So delays in realistic timelines. We've got service provider delays. So in order for me as a mortgage person and any mortgage institution to do their job and do their due diligence, there are third-party providers that we rely on in order to verify what we need to verify. So for example, the IRS, at the moment, the IRS is not processing what we call a 4506T, which is a form that we have you complete as a consumer, sign, send in, and then the IRS will validate whether the income that you presented to us as a lending institution is the same income that you paid and reported to them. But at the moment, that's not being processed, so lenders are having to think of alternate ways to verify that information. Now, same goes with appraisals. You've got your typical appraisal, and then you've got a family law appraisal for somebody that might be going through a divorce or something like that, or considering a buyout. Now, most appraisals or appraisers that participate in a family law appraisal are probably also participating in your traditional appraisal for a refinance or a purchase. Now, I just mentioned a few seconds ago the watermelon going through the hose. And if you have a lot of people refinancing, then that means you've got many appraisal orders. And I spoke to an appraiser not too long ago, and he's telling me he's seeing a dozen properties a day. Now, the problem with that is you might go see a dozen properties a day, and then you still have to go back and write those reports up, and then you've got another dozen the next day. And as you can imagine, this backlog starts happening, which now delays the turn time of you having this appraisal. Same thing goes with escrow and counter recorders and courts closing. Because of the way that the environment is, Lori gave the example of the person rolling out to the car with a little cart and, face mask and everything. We're having to do things differently. I may be ready to close on a loan today, but if that particular title company isn't taking any appointments and now we have to deal with a third-party notary, then now we're subject to somebody else's timetable, which can add a delay to your closing. Now, expect daily changes, and this is also very painful. This is not fun. Long-term closures will continue to push out delays. Timing is critical. Right now, anybody handling a mortgage or working on a mortgage, you have to be specific. Orders need to be tight. Documentation needs to be clear. That way you don't add to the further delays that are already expected. So having said that, let's talk about new appraisal guidelines. Now, guidelines are agency specific and rapidly changing. And when it comes to appraisals, I mentioned that you've got your traditional appraisal, place an order. I'm the appraiser. I go out, take a look at your home, take pictures, do the measurement, and then I provide you with the report. That's your traditional appraisal. But current options available are changing. So here's what's available now. So you've got an exterior only inspection, which was available before, kind of went away, and now it's back. It's a double-edged sword when it comes to an exterior only inspection, because let's say I have really maintained my home and I put in really nice flooring, really nice countertops, really nice appliances, and I've just really kept it up really sharp. Well, if I'm having an exterior only appraisal being completed, then that person drove up to the home, took pictures, went back to his office, and then came up with the value based on comparable sales, which is correct. However, he may have not seen all of my upgrades. So therefore, I may not get the right value or as much as I could have. And it goes the other way. Maybe I did not take care of my property and it is jacked up. I might end up getting a higher value than what I should have. So it's a double-edged sword with these exterior-only inspections. B, you've got automated valuation services, which I do like, especially for somebody trying to a refinance. If you don't have to complete an appraisal, because now there's so much data available online that many lenders and servicers are now giving you this option to waive an appraisal as long as they feel comfortable based on the online data that they can verify when it comes to the home value. And then last but not least, re-inspections by agents or consumer with supporting documents. So re-inspections nowadays, if you have to do a traditional appraisal, and let's say the appraiser has to go back out because there's a broken window and now the lending institution wants that window fixed, if he has to go back out there, and we already know he's got a dozen orders a day, you can imagine how a simple verification of that window being fixed could delay your transaction because you're waiting on him to go back out. Now, let's talk about impact on mortgage approval, which is mine and consumers' biggest pain point at the moment. Also very painful, not fun at all. But here's our reality. Reduction in income, workforce or hours worked. We have to keep updated documentation. Traditionally, you have to have credit documents updated and they're valid and you can close as long as you close within 120 days. However, because of our current environment, don't be surprised if lenders nowadays want documentation from a shorter timeline because they want to make sure that if we are issuing a mortgage that you still have the ability to pay it back. So they want to do the responsible thing. So updated documentation, don't be surprised if you need a pay stub and then another pay stub and then another pay stub because it's just what they need to make sure that there has been no changes or reduction in hours because if you're, let's say you're qualifying with your 40 hours, but then you make an additional $20,000 a year in overtime and all of a sudden that overtime goes away, that's going to be a problem. Maybe your $500,000 qualification without the overtime drops to $300,000 and that can be a challenge. Availability to verify employment has also become a challenge as we have this stay-at-home order and some companies may or may not have all of their employees working at home. Verifying employment can become a challenge if they're not easily accessible. So you can expect some delays there. Now, unstable rental income. Traditional way to verify rental income when it comes to qualifying might be through lease agreements or your tax returns because you're using that to offset the mortgage to help you qualify for your purchase or your refinance. However, with the current announcement that Lori mentioned, renters can't really get kicked out of their homes. So don't be surprised if nowadays a lender and underwriter may want to verify that you are truly receiving that income. It makes sense. It's not fun, but it makes sense. They want to make sure that that income is still being received in order to help you qualify. Same goes with missed child support or spousal support payments. You have to keep in mind the 6 by 36 rule, which means in order to use child support or spousal support, you have to verify that you've received six continuous payments without interruption and that it is expected to continue for 36 months. So an easy example of this is child support income. I verify that, yes, I've received these deposits for the last 6 months and I've got a court order for it. And here's a child, the birth certificate, which shows that the child is 10 years old, and therefore you would verify that it is expected to continue for 36 months. So that's the rule when it comes to that income. However, with the reduction in income in workforce, if the person paying the child support or the alimony is no longer earning an income, then that can become a problem because now you can't use that income to help you qualify. Now, potential credit issues. Please, by all means, I can't make this clear enough. Forbearance does not mean free payments. That is just simply not the truth. If you have the ability to make your mortgage payments, please continue to do so because one simple late mortgage payment is catastrophic. You can easily lose 100 points plus by just missing one payment. Another potential credit issue that we're noticing is consumer behaviors. Right now, with everybody having these stay-at-home orders and many people not working, we are noticing an increase in debt. As consumers want to hang on to more of their cash, naturally, we still got to do what? We still got to eat. We still have to spend. There's still things that have to be paid. So many consumers are utilizing credit much more and hanging on to their cash, which has a potential impact on your qualification, your credit scores, those kinds of things. And overall, the biggest impact when it comes to mortgages and approval is consumer fear. We live in this amazing age where information can be shared in an instant, even the wrong information. So consumer fear is at an all-time high. I've seen many clients, Lori and I have seen clients that have the ability, they have the income, they have the down payment to cut the credit, but because of fear, they have chosen not to participate in purchasing real estate. And we respect everybody's decision. You do what's best for you, but just that fear is literally paralyzing many people that could benefit from homeownership at the moment. Now, let's talk about this 90-day grace period, because this is something big, and this is not going away anytime soon. So what is happening right now? Well, there's a lot of interagency confusion, and here's why that is. So I may call my servicer, and my servicer may say, okay, Jorge, we're going to let you skip 3 months worth of payments, but and let's say my payment was $2,000 a month. So congratulations, Jorge, for the next 3 months, you don't have to make those $2,000 a month payment. However, come the fourth payment, we need you to pay us back all 3 payments, which is $6,000. Can you see the problem there? If I can't give you $2,000 now, am I really going to be able to give you $6,000 later? That can become a really, really big challenge if the consumer doesn't understand that that's really what's expected. So that's one option I may be given. Or let's say I call my servicer and they say, great, Jorge, congratulations, you qualify for forbearance. Here's what we're going to do. We need you to call us every 30 days. And then for up to 3 payments in a row, we're going to let you skip a payment for up to 3 months in a row. But you got to call us every 30 days. And then at the end of the period, then we're going to increase your payment by couple hundred bucks. That way you can pay us back those payments over the next 2 years. So that's a second option, which seems pretty reasonable. However, what is the official guidance that has been given? Well, we know that the government has said, yes, help your people, give them options, give them forbearance, but there is truly no official guidance on how they should do that. So every lending institution is now doing it their own way, which the concern is if you have too many people that don't understand what they're doing, the long-term impact could be defaults. Because if you have 1 million people that don't really understand what the forbearance means, and then they all of a sudden can't make their monthly payment because now they're expected to give 3 payments in a row, that could be a big rise in defaults, which is an area of concern. So having said that, let's look ahead. Here's what's expected. Ever-changing guidelines and pullback in bank product. Don't be surprised if you qualified for one program, right? And I'll give you this example. I had a down payment assistance program, which is still available, but the particular option that this gentleman wanted was for the moment suspended. So now we have to give him a different option. So don't be surprised to see those kinds of things happen, not just with down payment assistance, with lending overall. One credit score requirement today may be 630, and then tomorrow it could be 650. It's just a very fluid situation, and you can definitely expect the overlays, like we mentioned in the beginning, to be here for now and in the future. And of course, a lot of riskier products being pulled back or suspended for the moment. Additionally, when it comes to home values, we can definitely expect weakening home values, but not to be confused with what we saw back in 2011. I think that's really a big misconception that consumers have today. They might say, okay, Jorge, great, I qualify. Well, I'm just going to wait it out because back in 2011, my uncle bought a house for $35,000, and that's what I want to do. Well, circumstances are different. We mentioned back in 2008, credit was flowing, and it was very, very risky lending. And in the last decade, because of Dodd-Frank, the majority of the mortgages that have been issued are good mortgages, fixed 20-year, 30-year, 15-year fixed mortgages. So you don't have millions of people's payments about to reset, which is what really happened in 2011, and that caused values to just plummet. But right now, we're not really expecting that. When we talk about weakening home values, what we're really meaning is if you've got, let's say, 50% of people that have the ability to qualify, and 50% of them just say, forget it, I don't want to buy right now, I'm just not comfortable, then now demand goes down. And naturally, as demand goes down, then me as a seller, if I really do need to sell, then I might have to entice the current buyers to want to bid on my home. So I might have to do a $5,000 price reduction, or I might have to do a credit for closing costs in order to motivate you to buy my property. So that's what I mean by weakening values, but not crazy like 2011. Another thing to continue to expect is delayed closings. Especially if interest rates remain at the current low levels that they're at, you can definitely expect more and more people wanting to refinance, especially now. If there's all this fear about employment and the coronavirus and everything, people want to save money. So if you can drop your monthly payment, why wouldn't you? So you can expect delayed closings because of this continuous influx of consumers wanting to better their situation through a refinance. And then one of the biggest things also is companies potentially closing their doors. That is a hard reality that companies will face as things change, as their exposure to risk and risky loan changes. Don't be surprised to see some lenders go in and out of the business, or others be absorbed by bigger lenders. So having said that, we're here to help. Here's some of the tools that we can help you for settlement. If you want to go ahead and walk them through it, Lori.
Yep. So between Jorge and I, we can assist with things such as equity calculators, mortgage calculators, title searches, fair market valuation. So if you're thinking about selling your home and you want to know where your property value lies today, tomorrow, next week, things of that nature. So, and again, since this presentation was originally created for a specific audience, some of this is not necessarily relevant to the general consumer, but if it's anything related to real estate questions, lending questions, we're certainly here to help. Our information will be on the Facebook page. So hopefully you found this information useful. And of course, if you have any questions, please feel free to reach out to us.
Have a great day.
Now I just have to